Hey guys, welcome back to another episode. In this video, we will explain the concept of supply and demand areas and explore how they differ from traditional support and resistance levels. We will show you the best technique to identify high-quality supply and demand zones using smart money concepts. Lastly, we're going to cover a confirmation entry setup in the lower time frames to trade supply and demand more confidently. Knowing this will give you a significant advantage, as you will be trading in alignment with big institutions and the correct side of the market. Here is what we're covering in this video. So, if that's something you're interested in, make sure to smash the like button for me to show your support and subscribe to our channel if you're new. See you after the intro and disclaimer. So, starting with the basics. What is support and resistance? Support and resistance are zones where the price has reacted in the past and could react once more in the future. Now, on the chart, you've noticed that the price has pushed up, hit this area, and reversed. We call this area a resistance, indicating that, for whatever reason, the sellers have opened short positions, and the buyers have closed their longs. This double action is what makes the price reverse from this area. Following, the price pushed down, hit this area, and reversed, making it a support zone. It indicated that, for whatever reason, the sellers have closed their short positions, and the buyers have opened their longs. This dual activity is what makes the price reverse from this area. Now, why do we need to mark these zones on the chart? Here are 3 important reasons. Number 1. The levels that price reacted to them previously have a high chance of getting rejected again. So when we approach these levels, we will closely observe the price action for possible rejection. This will help us set our profit targets, especially if they are higher time frame key levels, because a small reaction to these levels would be a major reversal in the lower time frames. Number 2. Identifying the market direction. When the price breaks through a resistance level, it shows that the buyers have overcome the sellers, signaling bullish momentum and possible upside continuation. Similarly, breaking below a support level shows bearish momentum, so we want to trade with the dominant trend. Identifying the direction is the first thing we do when we open the candlestick chart. Number 3. Identifying liquidity. We know for a fact that when the price reaches the support and resistance levels, the price action traders look for trading opportunities. Break and retest traders will buy this pair if they see a sign of rejection in the zone. They will put their stops below this level, predicting upward continuation. Now, if there is not enough liquidity to push the price upwards, there is a high chance for the market to break below this level, grab the liquidity, and continue pushing up. So, if our entry is below this level, it could be a double confirmation that we will witness the moves we want to see in the market. So, the traditional support and resistance are considered liquidity areas as well. Now, what is the supply and demand area in smart money concepts? Supply and demand areas form on the chart when smart money enters the market, causing significant price movements. We can't refer to it as a demand zone when we have rejections with multiple small candles. A valid demand zone forms on the chart when the market prints large candles, indicating aggressive buying pressure. The momentum candles tell us that big institutions, banks, hedge funds, or basically the smart money, is in the market. Similarly, a valid supply zone forms when we have aggressive bearish momentum in the market. Now, how do we measure the aggressiveness of a price movement? Well, we do this by identifying the fair value gaps on the chart. A fair value gap is the space between the wicks of the first and last candle in a 3-candle sequence. The bigger the gap, the more aggressive the movement. The fair value gap is a sign of imbalance between the buyers and sellers, which indicates entering a large amount of money into the market. Typically, the price revisits these areas to fill the orders that were left behind and restore the balance. Now, there is another criterion that makes a supply or demand a valid area: breaking a structure level to confirm the momentum. It provides a key indication of potential market movement and aids in making informed trading decisions. If you're uncertain about the market structure concepts, watch our previous videos on this topic first. You can find the links in the description. Now, how to mark the supply and demand zones on the chart. Let's start with the basics. The first step is to identify the fair value gaps and breaks on the chart. Once we find a move with these criteria, We mark the demand like this. We draw a rectangle from the high to the low of the last candle that creates the fair value gaps as our demand zone, which we believe that the decisions are made during this candle. The same concept applies to the bearish scenario. Regardless of the candle's color, we will mark the last candle that created the fair value gap on the chart as our supply zone. There are various ways that traders mark these zones on the chart, but the key point here is your stop loss must be somewhere safe in case of market fluctuations. Now, we mark 3 types of supply and demand zones on the chart depending on the market structure formation. This includes order blocks, order flows, and consolidation areas. Order blocks are optimized supply and demand areas. Here we have an aggressive buying with clear fair value gaps leading to a break of structure. This is the latest candle that created the fair value gaps, so we draw it in. Now notice how the price swept the liquidity below this candle before taking off. Here comes a question. Where is the safest place to set our stop loss if we place a buy limit at this order block? It is below this wick where the movement has started. So we will add this area to our order block zone as well. Then, we wait for a correction and get into positions when the trading opportunities arise. Once again here, this is the last candle that created the inefficiency. But the same question. Where should we place our stop to be safe from market fluctuations? The answer is above this swing high. So, we will also add this area to our order block zones. Now this might make the trading zone and our stop larger. Still, later in this video, I'm going to show you how to optimize your entry in situations like this to enter at a better price. However, sometimes order block forms as candles with opposite colors in the middle of the heavy movement. We know that the institutions and big players love to use these zones to fill their remaining orders. So, we also consider them as order blocks and look for trading opportunities when the price returns to these levels. Now let me explain to you the second supply and demand zone that we mark on the chart, which is the order flow. But before we continue, if you have enjoyed this video so far, as always, please hit the like button to show your support and subscribe to our channel if you're new. Also, if you're an experienced trader looking forward to getting funded, register with our trusted prop firm, Funded Next. Funded Next is one of the top-rated prop firms on Trustpilot that provides one of the lowest spreads and commissions in the industry. They offer a variety of plans for traders with unique services, including a 15% profit share from the challenge phase and a 10% profit target with no time limit. If you're seeking a prop firm that genuinely supports your trading journey and provides financial needs, register with the link in the description to get a 10% discount with our exclusive code and experience their exceptional services for yourself. Order flow is an area where the buying or selling pressure was building up before an aggressive movement in the market. The bullish order flow is where the last bearish pressure was present before the bullish move. Similarly, the bearish order flow is where the last bullish pressure was present before the bearish move. Order flow areas are also considered a key supply and demand in smart money concepts. For example, here we have this move that created fair value gaps and a break of structure. These two candles are the last bearish momentum before the drastic move happens, so we draw them in. The order flow area might be a large zone and usually contains the order block within itself. Sometimes the price reverses before reaching our order block and makes us miss the trade because it's rejected from the order flow area. However, this scenario also emphasizes the importance of closely monitoring market structure for optimal trade execution. The last key supply and demand is consolidation areas. Consolidation areas occur when buyers and sellers are not strong enough to drive the market into a trending position, creating a sense that the price is trapped within a box. This situation persists as liquidity accumulates, eventually leading the price to a breakout in one direction. Then, the consolidation area becomes a key supply or demand for traders. However, we still need to have some imbalance before considering this area a valid supply and demand. For example, here, the price was consolidating in the Asian session before the London liquidity entered the market. So, this consolidation area becomes a perfect demand zone for long opportunities. Our stop will be protected above this zone, and we can set multiple targets. However, similar to the order flow areas, the consolidation zones sometimes can also be a large zone to trade. If we enter the position at the start of the move and put our stop below it, we will have an extremely large stop loss. So I'm going to show you some of the best techniques we use to enter better trades. However, you need to personally backtest it to obtain the performance and gain the required confidence to trade. We also do plenty of backtesting every day with the aid of the TraderEdge software. Let's suppose we want to backtest a trading setup on Eurodollar. We will first set up the chart on TradingView and adjust it. Then we will open TraderEdge's backtester and arrange it next to the chart. Here we will input our starting balance and risk per trade, which we've set to 2%. You can change this to any value you prefer, whether in dollars or percentages, for each individual trade. Once we're done with the backtesting, TraderEdge will provide us with a detailed matrix, including important information such as win rate, maximum drawdown, and profit results. It also allows us to save the data and add more backtests, which will all be stored in the strategy library. If you're interested in using TraderEdge, you can sign up for a 7-day free trial by checking the link in the description. Now let me show you some of the best techniques to trade the supply and demand levels and enter at a better price. First of all, we always look for trades with at least 1 to 2 risk-to-reward ratios before reaching our first target. Our first target is the latest high that the price recently created. So, if your setup has a 1 to 2 risk-to-rewards ratio, you can set your entry at the start of the order block and place your stop below the swing low to give the price room to breathe. If your order block is a tiny area, you can add more rooms for a stop to be safe in case of market fluctuations. But if your order block contains a large zone, you can have your stop a bit below the ending. However, here are 2 entry techniques if your trading zone is a large order flow or consolidation area. In the first one, instead of placing the trade at the start, we will enter at the middle of the zone and put our stop below it. This way we can cut our stop by a significant number of pips. The psychology behind this technique is optimizing our supply and demand area and our entry and exit points. The next technique is to wait for confirmations in the lower time frames, which we like to do most of the time, because no matter how good your trading zone is, there is always a chance for the price to ignore and break through it. We've already explained multiple entry techniques you can use in the lower time frames, such as change of character entry or retracement levels. Still, here comes a very important point. When our trading zone is large, we need more confirmations to enter the trades, because the market loves to take out the early buyers and sellers. Sometimes, when the price enters a large demand or supply zone, it provides many false signals before a reversal occurs. That's why we need a double confirmation after the change of character appears on the chart. When we are talking about the change of character, what do we mean? Let's just say, for example, we're in a downtrend, and the market continuously makes lower lows and lower highs. Eventually, for some reason, the price makes a change of character. It violates the previous market structure high, signaling a possible reversal. Now this is when we look for rejections from the recent demand area created by change of character move. However, in case of a false signal, the market will continue to push lower, making us lose the trade. So, we will be looking for a double confirmation. We will wait for the price to break the new high to the upside and create a new structure level. This way, not only got a change of character, but also the continuation of the market structure. So basically, a change of character should be followed by a break of structure for double confirmation. Then, the new supply and demand levels should be respected. Now let me explain it with a chart example. Here, we have an obvious moving downtrend on the 4 hours chart. If we mark this order flow area, we would have a large zone to trade. So we will zoom into 15 minutes chart to look for confirmations to enter short positions. Here on the 15 minutes chart, the price makes a false change of character signal, but then continues pushing up. So, a double confirmation would have been to wait for the price to break below the new structure level to confirm the reversal. Now, as usual, let me open the TradingView chart to show you step by step what is going through our minds when trading opportunities arise. Here we have the Eurodollar in 1 hour's chart. We have recently broken above this key level, which signals possible upward continuation. We have fair value gaps, which show bullish momentum. And this order block can provide us with a perfect long opportunity. Now let's zoom out to the 4-hour chart to see the market in the bigger picture. The 4 hours chart reveals that this area is an important higher time frame level, since it has rejected the price multiple times in the past. But the price action shows a sign of weakness and a possible break to the upside. Because rejections are getting weaker every time, and it is possible for an even weaker rejection before the break. Anyway, the anticipation in the 1 hour's chart is that the price is going to hit the close of these candles, at least even if a reversal is coming. So, we will open a buying position precisely on this order block, put our stop below the zone, and target the close of the latest high. The price triggers our order in the London session, which has a high liquidity, and it is another confirmation that we will witness the move we want to see. So guys, that's it for this video. I hope this video provided value to you. If it did, please go ahead and smash the like button to show your support. And if you're new here, consider subscribing to our channel. See you in the next episode.